All right, turning back to the major indexes, joining me now is David Stryzewski, CEO of Sound Planning Group, a financial services firm. David, good to have you back on the show here. And we do see some losses across the board. What do you recommend investors do in this market?
Well, great to be with you here as always. And, it's kind of confusing right now, I think, for everybody. Sort of like we're getting the weather report here and all the expectations say that it's going to be pretty stormy. And then, we look out the window and it doesn't exactly look stormy. We've seen amazing rallies here through January. And, maybe we're starting to catch up with some of this information. But, hey, we're seeing it cool down right now. This is ultimately what the Fed wants is a cooling down market. Otherwise, we get too far ahead of ourselves, and then they're going to be forced to really, raise rates and kind of hammer things on the demand side. So, it's one of these moments where I think that it's important to be calculated, but we also need to be patient. So, just having a really good strategy and outlook right now is very important.
What is the path forward for interest rates according to estimates that you see on your side here, and when might we see a pivot from the Fed?
Okay, so there's really three primary opinions out there today. So we've got the Fed's opinion and what they're telling us is going to happen. We've got what the market believes, and then probably what reality is. And so what the Fed's opinion is that they're going to be hiking rates here, probably going to get to about 5%, and then they're going to hold things for a little bit longer. What the market thinks is, and of course, what we're doing is we're talking about this terminal rate, this magic number that the Fed's not exactly sure about right now. But once they achieve that, then it's expected inflation is just going to come down naturally to this magic 2% number here. So the market thinks that we're probably already at a terminal rate. And so the market's expecting a pivot or a pause rather, and then a pivot later on in the year, probably Q3, Q4, dropping about a half point by the year's end. So that sounds great. Sounds like the perfect slashless landing that everyone's hoping for. But my personal opinion is that reality is probably somewhere in between on that. I believe that we probably have already hit a terminal rate with the Fed. So we're already seeing inflation come down right now. And I mean, it just 9 months to see these inflation numbers actually really hit and catch up. So that's why we're going to be pausing for a while. What I don't think is that there's going to be a pivot by the year end. And the reason why I say that is because if we really pivot, the market is going to just take off and it's going to go gangbusters here again. That is what essentially, could lead to more inflation and ultimately get us in the position that we found ourselves in the 70s, or Jerome Powell found himself in 2018 with the whole taper tantrum thing where, he was raising rates up and then he dropped them to accommodate. I don't think he's going to be dropping things to accommodate until we actually get something that's going to be pretty painful. And so that's not a great outlook for the market second part of the year. Because if we really believe a pivot's going to occur, that means that there's probably going to be something pretty significant that's going to break, that's going to cause the Fed to step in and take more dramatic measures.
So, David, I'm looking at a chart here, a one-year chart of the S&P 500. I'm glad you kind of said the obvious at the start here, right? It is a little bit confusing, still seems kind of uncertain as to where we might be heading, but we have seen some decent rallies, and we are making lower lows, and it appears higher highs. And so do you think investors should start dipping their toes back into this market? People wanting to put money aside in an IRA or a 401k or even their brokerage account?
Well, we definitely want to be dollar cost averaging, as that's going to give us the best average price in our investment horizon. Now, dependent upon someone's timeline, my firm primarily deals with people that are nearing or entering retirement. So it's really important right now to understand sequence of return risk or systematic withdrawal risk if you're nearing or entering retirement, because a big downturn could be very, very, very disruptive, mathematically speaking, in the first 5 to 10 years of the retirement or the last 5 to 10 years of a working career. Now, with that being said, hey, we still need to be contributing money into our 401ks as an example, because we're getting matched at our employer. So, that's giving you like 100%, upside day one just by matching and putting things in. But, we need to be evaluating our investment strategies as well. And so, I'm personally in a little bit younger of a phase than most of my clients today. And so I am dollar cost averaging in, just like I have been when the markets were more expensive. And I'm continuing to do so right now. But, dependent upon where someone is, it's very important right now that they look at having the right amount of cash assets, specifically the right protected assets, and then the right risk assets with the right strategy assigned to them. So we think, going a little bit more focused and rifled versus, shotgun index oriented is going to be really important. We probably want to be more active as opposed to passive right now, because there are names, just like you've been talking about here throughout the show, that there's names that are even competing against each other that are likely to outperform. And so we just want to find some of those right names here at the right time if we're going to be contributing.
And that's, what I do hear often, David, from many of our guests, right? Make a plan, stick to it, do that dollar cost averaging, dip in bit by bit according to your plan that works for you and your circumstances. And look, over time, the stock market has given us some pretty wonderful returns over the long term. So we'll be watching that closely. David Stryzewski, CEO of Sound Planning Group. David, thank you.